Welcome back, everybody, to another episode of Take Back Control Tuesday. Now, I can't tell you what the outcome is going to be for each and every one of you, but what I can tell you is for the next hour and 40 minutes, the time we're going to spend together, if you apply what you learn, this will change your financial future. If you're here, that means you're ready for change. And tonight, that's exactly what we're gonna deliver. I've got a special guest for you. His name's Jason Sipple. He is a master of what you're gonna learn. But what are you going to learn? Well, Jason's gonna teach you three things. He's gonna teach you how to take back control of your money by being your own bank. And then he's also gonna teach you how to build wealth through your own debts and expenses. That'll be the second thing you learn. And the third thing you'll learn, hence the cars, you're gonna learn how to get all the money back for every single car that you ever buy, drive, and own. And before you get into it, one last favor, just click that button right there, the subscribe button. It would do me a huge favor. And also, right above, there's a little bell. Smash that bell so that every time I put new content out, you'll be notified. So I don't want to waste any more time. It's time for Jason to really show you all about the infinite banking concepts. Let's roll.
Take back control.
Tuesday night.
Tuesday?
The Take Back Control Tuesday, and this is all about your journeys. What if by changing one thing, everything would be better financially for your family? How many of you would make that change? How many of you want more money? That one paradigm shift and new skill set is the gap between you and the wealthiest families. It's a difference between being a borrower or a builder. I'm gonna let you in on a little known secret, a little known fact that the wealthiest families and visionaries like the Rockefellers and Walt Disney have been using this strategy called the infinite banking concept for ages to build and preserve their empires. The strategy is simple, it's legal, and it's something that each and every one of you have access to. And it all starts with changing one thing. Start loving yourself more. Start paying yourself first. Shockingly, we're giving away a big chunk of all the money that we earn every time we get paid to the government, to the bank, and to Wall Street. And I'm going to show you how to take back control from them. Would it be okay if I share a little about myself and why I'm so passionate about this topic? So thank you for allowing me to share about myself. So I want you to imagine this. They're going to give you a job where you get to work like an extra 30 hours a week. You're going to take on a ton of additional roles, stress, and responsibilities. And the bonus, here it is, you're going to make zero extra money and have zero equity, no equity in the company. How many of you would want to do that? Nobody. You'd have to be an idiot to do that. And then it gets worse. I left this role to start my own company. And within a year, I found myself in another role helping a coach scale his coaching platform the first year of the pandemic from 0 to $4 million. Now I'm working 15 to 18 hours a day, 7 days a week, making a third of what I was making before, away from my family. And how many in the right mind would do that? Nobody, none of you. You'd have to be crazy. But I did it not once, but twice. Then I hit rock bottom. I was in the back of a mastermind in Mahwah, New Jersey, and we're in a room very much like this, but in person. And we're talking about what is our big vision, our big dream? Where do we want to go in life? How much money will we have? We're all getting pumped up and excited. Everyone is jumping up, screaming, and then I started crying. In that moment, I realized I had failed as a father. I wasn't providing, protecting, and creating for my family. And my wife, my sons, everybody I cared about, I was broken and I didn't know what to do. I knew my journey with that team was over. I knew that I had to make a change. And so I came home, I thought about it, I prayed on it, and I realized that I had a lot of rules around money that weren't serving me. And so I went to a friend and I asked him, I got humble and I asked him for help. And I called him up, or actually I was at his house, and I said, brother, I need a financial philosophy. And he handed me a book off of his coffee table, a marked up book that he had had for ages. I went home excited. I read it that night. It's on a Tuesday, and don't be too impressed. It's only 91 pages, but I got mad, like really mad. And so I read it again the next day, and I called him up, and I was ticked off. I couldn't believe my friend didn't tell me. And so I was like, Rep, what the bleep? Why didn't you tell me about this, man? I've known you for years. And he said, Sip, you weren't ready. And he was right. I wasn't ready because I hadn't started asking better questions. And so by the end of our time together, you're going to know how the wealthy are using a system that has you giving up control of your money. You're going to learn how you can give yourself a 35% raise. Would that be valuable? A better way to finance everything in your life and keep more money in your family forever. You're going to learn how to use your money differently and how the banks are making a ton of money off of your money. So again, by the end of our time together, you're going to know all these things. So how valuable would that be if you just knew one of those things, much less all three? And my only request for you today is that you keep an open mind, that anything you don't know, you just say, I don't know it yet. Just add the little ... yet. I just don't know it yet. So let's jump in. So R. Nelson Nash liked to say that the infinite banking concept was nothing more than an exercise of imagination, prophecy, logic, and reason. And let's play a little game together. I want you all, if you're not driving, just as long as you're safe, I want you to close your eyes and I want you to imagine that you're back in high school. You had just graduated, you're about to receive your diploma, and the commencement speaker stands up and asks you, how many of you are going to be successful by the time you retire? You're all going to be jumping up and saying, ooh, me, call on me, Jason. I'm going to be the next Elon, the next Mark Zuckerberg, the next Warren Buffett, maybe the next Donald Trump. Why? Because you believe that your whole life is in front of you. Everything is possible. And you can open your eyes. So everything is possible in that moment. But then something happens. It's slow, it's insidious, and it's prevalent across our country. So over the next few decades, this shocking statistic becomes our actual reality. From the Social Security Administration, only 5 out of 100 Americans will be financially secure at retirement. Financially secure just means that you don't have to go back to work. Only 1 out of 100 are wealthy. How is that possible? That's insanity. We live in the greatest country in the greatest time in history. How is that statistic our reality? That can't be true, can it? It is, because not you guys, but the other people out there, they've been taught to give up control of their money. They've assumed all of the risk, and it has them enslaved to a system that is not built for them. Or not built for the people. It's built for them, for the others, for the people that control the system. And it's very much like our friend Will Rogers said, the problem in America isn't what people don't know. It's what people think they know that just ain't so. Write that one down. The problem in America isn't what people don't know. It's what people think they know that just ain't so. And isn't that the truth? Like I said, this isn't a new concept. I already talked about a book, but let's talk about some of the people that you may have heard of that talk about the infinite banking concept. The first guy, he had a rich dad and a poor dad. Many of you have read his books, but he wrote this book that's not as well known called Second Chance, where Robert Kiyosaki talks about the power of whole life insurance. And then we had the guy who changed my life in 2019 before I left corporate America, where they'd give me all those extra hours for free with no extra money. But I went to an event in Miami, and this guy changed my life, and he wrote about this concept in Money Master the Game. The big guy, yes, that's right, Tony Robbins. Money Master the Game, section 5.2. And then finally, the book that's always within arm's reach, the book that changed my life, that my mentor, my friend Brian handed me, was Becoming Your Own Banker by R. Nelson Nash. A powerful book. And then you have a modern day take on becoming your own banker from two of my peers, two of my partners, two of my friends, Brent Kessler and Chris Naugle. And these guys make it even simpler in their book, Mapping Out the Millionaire Mystery, which is what we're going to do here together today. We're going to show you factually, step by step, how you can do the same thing. And then finally, when you understand that money and how money works, you want to know about the private money guide, private money lending, and how to use private money versus working with the big corporations. And so if you want a copy of Mapping Out the Millionaire Mystery, feel free to email me at jason@jasonsipple.com. I'll make sure I get you a copy of that. And then as far as this goes, take a look at this thing. Let's take a moment to talk about this intriguing concept, the backwards bicycle. Look at the neck on that thing. But I want you to think back, remember, lots of imagination. I want you to think back to when you were a child or when you were helping a child learn how to ride a bike. When you press down on the pedals, what happens? That's right, the bike goes forward. And the harder you pedal, the faster the bike goes. When you turn the handlebars to the right, what happens? The bike goes right. When you turn the handlebars to the left, what happens? The bike goes left. And now you're flying down the street, the wind's blowing through your hair, and boom, you crash. You get up, your hands hurt, your skin, you're like, and you're like, what happened? You look around and mom and dad are standing back, waving and smiling at you. Do you give up in that moment? Do you stop trying to ride a bicycle? No. You get back on, you keep riding, and you keep getting better. You don't just give up. That's why there's a saying, it's as easy as what? Riding a bike. Well, what if the bike didn't work that way? You guys can check this out on YouTube, the backwards bicycle. This welder decided to play a trick on the engineers. And so he welded that strange looking neck. And now when you rode the bike, when you turned to the right, the bike went left. When you turned to the left, the bike went right. Whew, that's wild. How many of you put bike if you think you could ride that thing in the chat? I do. And my only request from all of you is that you would hold your laughter until you made sure I got up and I was okay. Because it took this guy months and months and months to unwire and rewire his brain to be able to ride a backwards bicycle. And guess what? It took his son weeks. Why is that? Because when our neural pathways get so ingrained, like imagine skiing down a slope over and over, the same slope over and over and over and over and over again, and then trying to ski out of that rut you've just created into a new trail. It'd be really hard. Well, what if money worked the same way? What if everything that you've learned up to this point about money wasn't actually true? I mean, might be mind-blowing, but what if that was the reality, that it actually wasn't true? And so let's explore that. Let's explore some of the wealth killers. And I always talk about how there's two parts. There's the math side of things, like for all my engineers and spreadsheet wizards out there. And then what I think is more important is the mindset. They go hand in hand, but there's the math and the mindset. So let's talk about the wealth killers. The first wealth killer, taxes, right? Who here doesn't pay enough in taxes or wishes they paid more? Anybody? Anybody going to take me up on that? Does anyone wish they paid more in taxes? And then the next one, inflation. Think about the cost of goods now compared to what it was 5 or even 10 years ago. Wealth killers. And then market volatility. The market's going to go up. It's going to come down. It's going to go up. It's going to come down. Right? There's always going to be change in the market. And then interest. You know, the reality is we finance everything we buy. We either pay interest or we give up the opportunity to earn interest. And then the mindset side of things. We got the status quo, right? Doing what everybody else is doing. I get asked this question all the time. Jason, why don't more people do this? I say, that's a great question. Because the majority of people won't do this. But again, you guys are in that 5%. You're in the minority just being here. And so doing what everyone else is doing. And then fear. fear of failure, fear of rejection. That's how I break down all fears in life. It's either one or the other. You're either afraid you're going to be rejected or you're afraid you're going to fail, or maybe it's both. But there is no failure. That's a little clue for you. There is no failure until your last day if you didn't do the things you set out to do. But you tried, did your best. There is no failure. And finally, life distractions. You're here now, and so many people have seen this. They've known about this. I have a call set up now with someone who saw this 6 years ago, and they're ready to start. So whatever your timeline is fine, but just know that when you leave here, you will have everything life has to throw at you. You will have family situations, work situations, business, health, whatever. All of the challenges. We're going so fast. We're so connected. How many of you have ever picked up your phone to look up one thing and 40 minutes later, you forgot what that thing even was because you got distracted and went down a rabbit hole? So life distractions, they are real. They are wealth killers. And then what we're taught. I don't know how you all learned about money, but I can tell you from the majority of the other people I talk to out there, they weren't taught how money worked. They weren't taught about money in school. Even if they went for a degree in accounting or something else, they're not taught the things that I'm going to show you here in a moment. It's crazy. And so let's look at that handsome picture of Uncle Sam there. Let's talk about the mysteries of money. Let's together define what is the definition of money, or money is blank. What would you put in that next line? Money is what? Money is. I usually get freedom. There we go. There's my freedom. Great to have. I like that, Dex. Yes, money is great to have. And you should be able to say, I love money and money loves me. Freedom, we should have a conversation around that one, because if you believe money is going to give you freedom, you might be beholden. I say money might be the pathway to having freedom, but money is nothing more than a means of exchange. It's food for money, money for food. House for money, money for house. Car for money, money for, you get it, right? For car. What company uses compound interest? You might say the banks. Well, the banks might pay you compound interest, but that's not how the banks work. Because think about this, like say Dex walks into a bank and he writes Dex on a $100 bill and he hands it to the teller. The teller's like, good to see you, Dex. And Dex loves everybody, so he's high-fiving and saying hi, feeling good about his $100 bill. Does that teller take Dex's $100 bill, turn around, go stick it in a special safety box for Dex, and it just stays there until he comes back and gets his special $100 bill? No. The banks understand that money must stay in motion. It's like anything. Like you're not going to drink water from a stale pond or eat fish from that same pond. You have to move our bodies so we don't become what? Stiff and sick. Money has to stay in motion. So that $100 bill went out to work immediately for the banks. It doesn't stay there in Dex's special box. And then, are your dollars worth more today or in the future? What do you guys think? More today or in the future? Today. I love that. So think about this. If you had $1, like here I have $1 in my wallet, and I wanted to go buy a candy bar. I actually looked at this yesterday or 2 days ago, Sunday. So back when I was a kid, if I had $1 and went to the general store, I could probably buy 2 of my favorite candy bars. I could probably buy 2 Snickers. Today, I looked yesterday, you can get like a bite size for a little over $1, but a full candy bar was like over $3. And they make them bigger to get us sicker, to keep us unhealthy longer. Hey, not going down a conspiracy rabbit hole, but I'm just saying your money is always worth more today than it will be in the future. It loses value every single day. Taxes. You guys already shared that you maybe don't pay enough in taxes, but in the future, our taxes are going to go up or down. Now, I don't have a crystal ball. We're actually in a historically low tax period as far as the amount of money we pay on our earnings. But let me tell you this, the government, if you go to usdebtclock.org, we're over $34 trillion in debt, rising rapidly, and the government doesn't produce money. We are the government's greatest asset. So they're either going to raise taxes in the future or what? They'll just tax us on more things. And then what do you know about your retirement account? Call I had earlier today, an engineering like mind, a spreadsheet guy. And he told me, hey, I'm putting 15% into my qualified plan. I told him this very story. Now, I'm going to pick Emmy. Emmy, you and I are going to be partners. I wish I could see you, but here's how our partnership's going to work. You just met me, but trust me, I'm a good guy. I'm going to take good care of our partnership, Emmy. But here's how it's going to work. You're going to, in our business relationship, you're going to provide all of the capital, all of the money. Now, right away, Emmy might be pulling away from the camera, maybe logging out. Just think of this as if I'm forming that same partnership with you in that moment. So Emmy's like, it's a little weird. I don't know, Jason. You seem all right. Maybe. And then I say, and Emmy, as you put your hard-earned money into our partnership, I'm going to tell you the rules, when you can access it, if there's a penalty, how much you can access. Now, Emmy's feeling pretty uncomfortable right now. Wouldn't you agree? Is that pretty fair? And then finally, here's the kicker. I say, Emmy, you work from now until you're ready to retire. And then when you need the money, you've taken that little tiny seed and turned it into a great big harvest. And now you're going to walk back in, or I'm going to walk back in as your partner, Emmy, and I'm going to say, hey, psst, Emmy, shh, great job. I'm going to need an insert percentage, 34.5%, 28%, 24%. How many of you would enter into that partnership willingly today? Hearing that story. Anybody? Anybody want that partnership? I'm open to it. You guys put all the capital in. I make the rules, and I'll tell you how much I need when I need the money later. Nope. Emmy wouldn't take that. Sabrina wouldn't take that. But that is the agreement we have with any of our qualified plans. I'm not saying they're bad. I'm just saying understand what your money is doing. Now, that might have been a lot for everyone, right? We covered definitions of money, making it simple, compound interest. Are your taxes worth more now or in the future? Or dollars worth more now or in the future? Taxes up or down? These things might be a lot, and it might be a lot to understand, but just keep an open mind. Maybe this is actually how money works. This is actually what's happening with money. So let's talk about this system. Let's talk about how, remember I said we're going to map out the millionaire mystery today together. Let's talk about the three-step process. The first step is simple. It is the machine. I've already kind of given it away, the secrets out of the bag a little bit. I've told you it's infinite banking, but I'm going to show you what we use for the machine. And next we have the marathon. Now, I don't know how many runners we have here, but I hate running. The only time that I run is typically after I swim a whole, 2.4 miles and I cycle 112 miles. I'm not saying that to impress you, maybe a little, but I'm telling you more so because I want you to understand that the first concept, right? We're changing one thing, but the first concept is thinking long term. In our current setup, in the system that many of us use, we're thinking in days and weeks, hours, months. Now I want to start thinking in years and decades and generations. This is how the wealthy play the game. And then finally, the millionaire mystery, right? I promised we'd map it out. I'll show you how changing that one thing factually makes one of our clients a millionaire by the time he takes back control of his money. So let's lift the hood for this machine. Let's check out what we're building together and how does this work? So what is this magical machine, Jason? Well, it's nothing more than a specially engineered whole life insurance policy from a mutually owned company. Now, this mutually owned company has been around for well over 100 years, profitable every single year. And these are the companies, the 5 companies that we currently work with. It can shift, but those are the ones that we personally use. What is it not? It's just as important to express what this is not. This is not an IUL, a VUL, a UL, or term. In all of those, there's no control and no guarantees. Just keep it that simple. So for banking, for this concept, we are not, make sure you write this down, put a big underline under it. I don't want you driving into the poll that you were looking at. It's not an IUL, it's not a VUL, it's not a UL, it's not a term. They all have their place, but not for this system. And so now, since we've been going for a little bit, we're going to do something fun, something interactive. So grab your pens, grab your paper, grab, a marker, grab something to write with, and make yourself a T-chart. And in this T-chart, in the top left, you're going to write bank. In the top right, you're going to write policy. And underneath, you're both going to write liquid. But I want you to write that amount under bank. And if you don't have a high yield, just write 0.07. It's probably less than that. But this is what the bank's paying you on the money that you're storing there. Under policy, go ahead and jot down 3.25%. Now, 3.25% is your G1. What's a G1? The first guarantee, contractual guarantee that you have in this system. Under bank, all that growth on Anthony, Shane, anyone else who has a high yield is taxable growth. So all the money in the banks is taxable growth. Under policy, it's tax-free. Tax-free loans, tax-free growth, tax-free distribution. Better word or terminology is tax advantaged, but just know that that money is growing tax-free away from the government. And in the bank, we have unstable. Jason, what do you mean by unstable? What does that mean? I don't understand. Well, think about the beginning of 2023. We had the Silicon Valley Bank, right? $204 billion failure. The question we want to ask is why? Why was there such a big failure? And then shortly after, how did Signature Bank fail for over $100 billion? Go back to the great housing recession of 2008, 2009, 364 banks failed. How many large mutually owned dividend paying life insurance companies failed? 0. Why? Why is the obvious question? Well, banks practice fractional lending. And by the way, don't believe anything I say. Don't believe anything I'm telling you here today. Go do your own thinking. That's what you want. That's what I want for you. But when you look at fractional lending, it's like when we deposit $1,000 into the bank only keeps 10% and lends out the other 90. And over a series of loans with that same pattern, they're going to turn that $1,000 into 10,000 or that 10,000 into 100,000. It's inflationary, the system, and they don't hold any of the money. So when people need their money, when they get a little nervous about the bank, guess what happens? Everybody runs to the bank, and that's called a run on the bank, and there is no money. There's no money covering it. And under the policy, we have stable. Well, Jason, the same, define stable. What do you mean? Well, I mean profitable. Every year they've been in business for well over 100 consecutive years. So 119, 137, 148. For this example, 160. For this example, we're using 148 years since 1877. Impressive? And then finally, under bank, we have unprotected. Remember the wealth killers? The one I didn't put there was attorneys. But attorneys, liens and judgment. If you are an entrepreneur, E for doing everything. You're an entrepreneur, you're wearing a lot of hats. But imagine someone gets hurt on your property or hurt in your business and you're sued. Well, if your money's in a bank, guess what? A good attorney can get access to that money through liens and judgment. But under policy, especially in the great country of Florida that I live in, it's fully protected. And in every state, it's more protected than it is in a bank. So far, remember, think about making it simple as simple. We're talking about whole life insurance that's specially engineered for you, but the whole life part of it, the living benefits, what have we talked about so far? We've talked about guaranteed growth that is tax-free in a stable, protected environment away from Uncle Sam that we have access to the money. And we don't have any of those things on the other side. But like I will keep saying throughout this, it's going to get better. Now, on the bank side, imagine you had saved an amount of money. You need the money. You now what? Take the money out and you go back to what? Back to 0. So there's no death benefit under bank. There's no cherry on top. But under a policy, guess what? There's a guaranteed tax-free estate. That's a multiple of whatever cash you put in. So how great is that? You already have 2 guarantees in your contract with a policy. So now each of you, especially the ones with the high yield savings account, Shane, Anthony, anyone else, since you guys are doing really well and gals are doing really well with their money, now the bank is going to bring you in and say, "Hey Shane, hey Anthony, we've got this question for you guys. Being sharp guys, we have to store our money that has to be stable, liquid, and guaranteed and protected someplace. Do we keep it in our system or should we keep it in a policy? What's the answer? What do you all think? Are we keeping it on the left side in the bank or the right side in the policy?" Sabrina knows the policy. That's right. When you look this up, since 2013, banks have 4x the amount of whole life that they have, that they own, to the tune of having over $225 billion, the number one purchaser. That's what bank owned life insurance, BOLI, BOLI. That's pretty nuts, isn't it? That is a lot of money, right? That's a lot of money in the policies. So where should we all store our money? It's pretty easy. Now for this one, we had Anthony, right? So maybe Sabrina. Sabrina, you look like you could buy a car. And Sabrina, whether you want to buy, a $25,000 vehicle or a $250,000 Ferrari, right? Just add a zero. The numbers are going to work the same. But we're going to do an exercise again of imagination here and logic. And I'm going to be your banker, your host, your banker, all the things. So now Sabrina is a saver. She's disciplined. She's persistent. She's consistent. And we all appreciate that about Sabrina, don't we? And now she has her eye on this new vehicle. Sabrina, what color is your new vehicle going to be? If you could pop it in the chat, that'd be awesome. And she can't wait to have this new car smell, right? You guys know that smell. It's just delightful, right? It's awesome. Now, Sabrina's been saving her money at my bank, Jason's bank, and I'm giving her 4%. I'm pretty generous, not as generous as some other banks, but better than most. And Sabrina comes in all excited. She's just got an extra pep in her step today. She's going to get her new white car and she comes in. "Jason, I need my money." And I was like, "Whoa, hold on a minute. I know you need your money, but I got a better deal for you." And then I make my proposal. "Sabrina, why don't you leave your money with me? I'll keep it safe. I'll keep it uninterrupted and compounding for the next 5 years, the next 60 months. And so you can still get your new car, I'm going to give you a loan for 6%. And at the end of the 5 years, you will have made money. You're going to make money borrowing at 6 and leaving your money grow at 4. Most people are going to say, "Jason, 4 minus 6 is -2, is it not?" But let's look at what actually happens with the math. Sabrina gets her car. Her payments for the next 5 years is $483.32. Over that 5 years, she will have paid my bank $28,999. The future value of the money that she left in the bank is over $30,000. So I know how we do math here in Florida. I know you guys are from all over the country, but is $30,000 more than $29,000? Yes. Sabrina just made $1,526 and had her new white vehicle. But why, again, remember the why would I pay Sabrina 4% and let her money grow to make more money than I was charging her? Have you ever thought about that? Let's take this a step further. Now you guys already trust me, and you trust me to the point where everyone is going to give me all of their money. You're going to make money. You're going to go out and work, doing whatever it is that you do, and you're going to deposit all of your money in my bank because I've already showed you can trust me. I'm going to pay you 4%. And now let's look what I have to do. Remember earlier, money has to be what? In motion. So now, Sabrina, you got your new white car, you need a new home, you deposit your 100,000 in. I pay you 4% because that's how I do. And now I'm going to lend that money. I'm going to put it into motion right away. It's going to go out to work. And now the seller is going to bring the money where? Back to me, back to the bank. And now to keep up with the Jones, I got my beautiful blue new house. I need what? A blue Beamer to go in the driveway. So now the car gets bought, right? Finance from my bank. 8%. And now the money comes where? back to where? The bank. You moved into the new home and now your kids want a pool, or your spouse wants an office or a new kitchen or a bigger master bath. Sound familiar? Anyone go through that in their life? Yes, maybe. So now you do what? You do a home remodel. And now the bank's charging you 9%. The contractor brings the money where? Back to where? The bank. And now you forgot about all the other things in your new home that you needed: new garbage cans and new blinds and new towels and new, the house was bigger than the last house, new furniture. And so now you've taken on a bunch of debt, and then you get a debt consolidation in the mail. And you say, well, 12% is better than 25%, isn't it? And you consolidate the debt. And the money comes back to where? Back to the bank. So now this whole time, you were all making 4%, but the bank kept the money in motion. It's like a flower if you draw little lines around it. And the money always comes back to where? To the bank. So let's look at this. In the home, the bank makes 3%. In the car, the bank makes 8 minus 4, 4%. In the home remodel, the bank makes 9 minus 4, 5%. And the debt consolidation, the bank makes 8%. Now, in everything except the debt consolidation, how much risk did the bank take on? Hardly any, right? They could take the home, the car, or the home again as collateral. So they took on very little risk, but they made much more than Sabrina and all of you were making by having your money stored at Jason, the Honest Banker's bank. And look what I made, or the bank made, 20%. Now, the question for each of you, how much bigger is 20 than 4? And if you don't know, it's okay, but you might say 20 minus 4 is 16. Well, that is true, but not how percentages work. 20 is 5 times bigger than 4%. So the bank just earned 500% on your money. And if you just up until this point, if you want to earn and learn how to earn that kind of money on your bank, and you're willing to change one thing, well, the keys, the access to everything is right there on that QR code. You can scan that code if you're new and you've never seen this before and have a conversation. If you want to learn more, I'm going to keep going. So now, and remember, don't believe anything that Jason says, right? Go do your own thinking. But if you go to BauerFinancial.com, whatever bank you bank with, whether it's a local credit union, a big bank, a small bank, whatever it is, Navy Federal, whatever, you go to BauerFinancial.com, you will see that the banks make at least 400 to 1,300% on every single dollar that you deposit. Is that not nuts? Is that not crazy? Like super wild? You work so hard for your money. They play a different game. They understand that our money must go to work for us. So why don't we do the same thing? Now, this one, every time I show this, it bums me out a little bit. I'm not going to lie, because I stand against this. So this makes me sad because this has been true since the 1960s, this statistic. And after having 3,000 plus calls, I can tell you that it's not even as good as the picture I'm about to paint for you. It's worse than this. So of every dollar we make, 20 cents of every dollar goes to the cars, to our automobiles, our trucks, 30 cents of every dollar to the home, 40 cents of every dollar to everything else. That's lifestyle, expenses, things of that nature, food, necessities, and 10% savings. Last month as a country, we saved 4.9%. Since 1985, we are well below the 10%, which is the first law of wealth that is shown here. We have been saving less than 5% for years now. Do you know what the wealthiest 1% save since 1910 on average? 38%. Remember how the wealthy, how they play a different game? Well, let's look at now how much interest we pay in every one of these transactions, and how by taking back the control from the banks, recapturing, recycling our money, we can do the same. So now for automobiles, 5 cents of every dollar goes to financing. Now we're going to shift that back over to the savings. Now we got 15 cents of every dollar. You guys following what's happening here? And now for your mortgage, and we typically are going to trade in our car every 3 years, right? Because the mileage isn't too high. We want that new car smell again. And we just reset the clock. And we're going to do that 11 to 13 times during our lifetime with automobiles. It'd be pretty cool if you knew a better way to finance all of your automobiles, right? You might see that here. Next, we got the housing. 25 cents of every dollar, like especially if you bought a home in the last 5 to 7 years, because guess what? That's how often we move. Do you think the banks don't know our behavior better than we do? 25 cents of every dollar back to the other side. All of a sudden, you have what? You have 40 cents of every dollar already back in your system by doing what? By just changing the environment, changing one thing. Everything else, 5 cents. There is your 35-cent raise. Add that to 10. You are now saving 45 cents of every dollar. And you might say, Jason, I can't do that. I'm barely getting by. If you're thinking that, just hang in there. I'm going to show you how you can do this. Okay, we're going to show you a real life example coming up. Now, a moment ago, I teased. I said, hey, wouldn't it be cool if we had a better way to finance everything we buy, drive, and own? Because I know how all of you have bought your vehicles. You've either paid cash, leased them, financed them, or maybe someone here might have stolen them. I don't know. Probably not. But that's how everyone gets their cars in the States, right? Hopefully, it's the first three and not the latter. But let's look at it a different way. Let's look under the hood and talk about using the machine, the specially engineered whole life policy. And things we're going to talk about are premium deposits. Why premium deposits? Because most people think of premiums as a cost. When you understand you're building your system, the language matters. It becomes a premium deposit. Age doesn't matter. I have many videos showing whether you're 21, 31, 51, 61, or 71, as long as you have good health, the cash value will be about equal, whether you're 21 or 71. So if you think it's too late, it's probably not. Probably not. Just depends on what you want to do. And the death benefit, super important to myself with my two boys, my family, most of my clients, very important to them, that cherry on top. But remember, we're just talking about a better way to finance things. So let's go back to Sabrina. She bought her car earlier. Now she really trusts me. She got a white car. She's going to put $10,000 a year. And if you believe like I do, the wealthy have more choices. So whether you pay into your system monthly or you pay it annually, you can make that choice and change it every year. But Sabrina's just going to deposit 10 grand a year. After 3 years, she's ready for another new car. Takes a $25,000 loan. She's paying her system back, being an honest banker. So rather than paying $483, she's now going to round it up. It's like when you go through the grocery, you want to round up and donate. Yes, I want to donate to myself. I'm going to round up, pay $500 a month, which is $6,000 a year. You guys following me so far? So now over 7 years, Sabrina, you have deposited $70,000 into this account. You've taken a loan for $25,000. You've been honest and paid yourself back $6,000 a year for 5 years. And so now at the end of this time, $75,000. And look, your cash value is still $67,881, meaning that you have 91 cents of every dollar that was deposited and the vehicle. Have any of you ever had 91 cents of every dollar that you spent on a vehicle and the vehicle at the end of your financing period? Ever? It gets better. Now we're going to do something completely insane, completely crazy, something I would never tell you. I would never, ever tell you to do this, but we're going to get wild. We're going to get crazy on this Tuesday together. Sabrina, no more policy payments after year 7. You're going to just stop. You looked at it as a cost. You don't want to do it, whatever it is. You did not you, it's us. So you stop. But guess what? That car doesn't smell so new anymore. It's gotten a little beat up. Someone's kind of dinged your door while you're at the grocery, even though you parked far away from everyone to protect your beauty. Now you need another vehicle. You take another loan. You're still going to play honest banker and pay yourself back. Now at the end, you're going to have $30,000 that you paid back, $25,000 loan, a difference of $5,000. But look, your cash value in the last 5 years has grown by an additional $23,592. You've made money on car number 2. You haven't worked any harder. You've just changed the environment. Where does your money sit? So let's look at these 3 rules. The first rule is pay yourself as if your life depended on it. Because guess what? It does. Paying yourself first is the first law of wealth. And if you don't follow this, you aren't going to be successful at the game of finances, at the game of money. And that's okay. It's really important. It's your life actually depends on it. And then you want to pay yourself with interest, right? If you're willing to pay interest to everyone else, why not pay your system and be an honest banker? And then finally, you want to recycle and recapture your money. And this is a combination of continuing to make the premium deposits and not stopping in year 7, being an honest banker. So why? You're keeping all the money flowing back to your system so it can do what? You build the opportunity fund so it can go out and go to work for you again. You want to recycle and recapture your money. So if this works for the white car, for the truck I'd want to buy, for your vehicle, what else can this work for? Everything. Now, remember when I said I'm going to show you how to turn your debts into assets? This was an actual client that saw this very presentation many, many years ago. Not done by me, but done by the founder of the Money Multiplier, Brent. Now, Brent came over to Chris. Brent did a presentation. Chris was with him. And this potential client walks up to Chris at the end. He says, Chris, can you help me? And Chris takes a look at him. It's a 45-year-old chiropractor in Minnesota. And says, I don't know, doc. It depends. Tell me what we're working with. Show me what you got. Show me everything you got coming in. Show me everything you got going out. Financially weigh in with me, doc. And so the doc put everything down. And they found that he's paying $5,777 a month. And look at the interest rates to other families. I want you guys to think about this is money going to other families. Remember, this 45-year-old doc probably had a nice smile, but did the banks give him a loan for his boat, for his car, for the home remodel, for everything, the condo, because of that smile? No, because logically, they're making a lot of money. And so Chris asked the doc one more question. Doc, how much are you saving? And the doc said, not much. Well, doc, are you putting any money in your qualified plan? Well, actually, yes, I am. 25 grand a year. And Chris said, will you change one thing? And the doc said, sure, if it'll work, if I'll get out of debt faster. Because at that moment, that was his biggest pain. Debt, stress, pressure. You feel it. I felt it. I've been there multiple times. I've made all the mistakes financially, by the way. And so Chris said, okay, doc, we're going to change one thing. We're going to build you a specially engineered policy. And we're going to show you how you're going to get your debt back much, much faster, paid off much faster. So in year 1, we're going to make a $25,000 deposit because we just moved where his money's going. He's not working any harder. Takes a $14,000 loan, pays off Discover, pays off Lowe's, pays down Nordstrom. In year 2, he's going to do the same thing. Make a $25,000 deposit. Cash value does what? It went up. The payments now paid himself, being an honest banker. He has $21,000 of money. And what's he do? It's not new money to go spend and buy new things. No, no, no. He's going to pay off Nordstrom's, pay off Wells Fargo, and pay off the private loan, and pay down the Beamer. So within 2 years, remember it was going to be 19. Within 2 years so far, this doc has already recaptured almost $2,000 a month, almost $24,000 a year. That's pretty wild. And by the way, I'm trying to make something that's super boring really sexy for all of you. I hope you're appreciating that. Year 3, makes the same deposit and something really cool happens. The doc hits the efficiency point. Every dollar, and what I mean by that is every dollar going into his system gives him more than $1 tax-free he can use. Like R. Nelson said, if you knew that every dollar that you put into a system would come back to you tax-free by passive income time or / retirement time, would you hesitate to put more money in? Think about that for a moment. So this doc, year 3, deposits 25 grand, has more than that, pays himself back as an honest person, pays off the Beamer, pays off the boat that went with this condo. This is his lifestyle creep that got him. Now he's at 3,600 recapture only in year 3. So let's look at what we're doing. Remember we talked about this being a marathon? And this isn't that long of a game right here. We're only talking about a couple years. How much do we put in? 25 grand in year 1, 2, and 3 for 75,000. What were the loans? 14, 16, and 25 grand, 55,000. How much is left in this doc's policy? Is it 20 grand or is it the full 75,000? All of the money he's deposited is still in there and all of the cash value is still growing at a guaranteed rate and most likely earning this doc dividends as he used it. So we've shown you he's saving the money and spending the money simultaneously. Now let's fast forward to year 4. 25 grand in, cash value grows to 26,000 of tax-free money, takes a loan, payments back to himself of 44,000. He has gone down and paid off, almost paid off the condo. Nothing really that exciting happens in year 4. Year 5, same amount deposited instead of going to his qualified plan, and it's now giving him an extra $2,000 money back, pays off the condo, pays down the home. Almost all of the money recaptured, and we're 5 years in. Year 6, something really cool happens. It gets to a certain point in these specially engineered whole life policies. This is a big water glass, but this is 40 ounces. Is can you put more than 40 ounces of water into that cup? And hopefully you said no. I love creativity, but if you said yes, that's a disqualifier. I can't work with you. I'm sorry. But you can't put more water in. So at this point, his system has gotten so efficient. It's basically a cash machine for this doc that he has to expand. He has to expand his warehouses of wealth. So he starts a second policy. The doc starts a second policy. He does the first 10,000 a year. He has over 13,000 he can use tax-free. He makes the deposit just like the first time. In year 6, for the second policy, takes out a loan, pays himself back to 82 or 54,000, pays off the condo. So let's look what happened. Let's just kind of reflect for a second. It would have taken how many years for the doc to pay off this debt, the $5,777 a month? It would have taken him 19 years, and he would have paid a ton of interest and principal to their families. By changing the one thing, he brought all of that money within 6 years back to his family. Now, even if that didn't look like your profile, like if you don't have debt, you can still use the system to build an opportunity fund. Or if you do have debt, would you like to know exactly would be the most efficient way to pay off your debt, whether it's the snowball, avalanche, or the highest interest first? We'll show you that. And with your specially engineered whole life, as you're going through underwriting, we'll show you exactly how long, what's the most efficient, how long it'll take to pay it off, how much interest you recapture, and how long will it take you to build back up that opportunity fund so you can do what many of our clients have already done, what I've done personally. You build the opportunity fund up, you find something you know, like, and understand, and now you put your money to work. We can show you that, and it's free. So promise we're going to map out the millionaire mystery. But before that, I just got to ask you this fun question. How do you eat an elephant? Just yell it out. That's right. One bite at a time. As my wife likes to say, Jason, don't start at the ears. Start at the feet. Start at the bottom and work your way up. We're going to have elephant stew and salad and steaks, and we're going to find all new ways to make elephant. We're going to put it on ice. We're going to keep it for a while. It's a big animal. And no elephants were hurt during the making of this, I promise you. And how did the man or the woman arrive at the top of the mountain, right? They didn't fall there. They had to do what? They had to get there one step at a time. One step at a time. And remember, I told you that we're going to map out the millionaire mystery. So let's look at what happens when this chiropractor plays honest banker. He doesn't steal the peas, and he continues to pay back these debts. Okay? Over the time period left. Frank says, or a hippo. So we get condos, house, $500,000, right? Look at that. But it gets better. What do you mean, Jason? Well, as I mentioned, all these mutually owned dividend paying companies haven't missed a dividend in hundreds of years. So I can never promise it. But let's just be conservative and say it's 4% that this doc is earning on his money. Without changing anything, this doc has recaptured, just for these two things alone, $750,000. We didn't even finish talking about the Beamer, the boat, the other things. Easily well over $1 million with this conservative estimate. And now that you all know this, right? Now that you guys all know this, shouldn't you be doing this? And if you're not, aren't you stealing from your children, from your grandchildren, from the people in your life that you love. So we just learned how the banks make 400 to 1300% annually on your money. That's just nuts. And how many of you would like to earn that kind of money on your money, that kind of return? We showed you how you can turn your debts into assets, a better way to finance all the things that you need while keeping control of your money and protecting your family. That is the power of becoming your own banker. Do you know what the most common thing that my clients say to me? Jason, I wish I would have known about this 20 years ago. And here's the crazy thing about that. Do you know who knows about this? Rich people, right? Rich people know about this. And I guess they didn't let you in the circle. Well, ladies and gentlemen, men and women, welcome aboard. You now know how the wealthy are building their foundation and how you can do the same. Now, my good friend Warren here, I don't know him, says if poor people would just do what rich people do, they wouldn't be poor anymore. And now, at the end here, only one of two things are going to happen. You're either going to live, or, I'm sorry to have to tell you this, I feel kind of bad, you're going to die. You're going to graduate. You're going to move on from this mortal coil. And my question is, are you better off with or without the process? Now that you know what the wealthy have been doing for hundreds of years to build, create, and multiply generational legacy, thousands of our clients have been right where you're at in this moment. And not one person that took action has been disappointed. So you can either take ownership, take action, scan the QR code, or not. Either way, I'm super grateful that you have given me your most valuable asset, your time, your energy, your focus. But I'd hate for any of you to wait another year, like the guy who waited 6 years, and be exactly in the same place that you are today, stressed, unhappy, and worried about money all the time. How many of you would want to stay in that energy, worried, stressed, and frustrated? I know I can help you. I've helped thousands of people. Scan the QR code if you want. If not, no worries. Again, I'm blessed to have spent this time with you. I still love you. I want what's best for you. And keep spreading this message. So God bless you. Be wealthy, be healthy, and thank you for your time and your energy. I appreciate each and every one of you.